Thank you, Karel. I'm really lucky. I tell you how lucky I am after the session in more private atmosphere. Good afternoon, ladies and gentlemen. It is my pleasure to speak to you at the 6th International Insurance Conference of Insurance Europe. I would like to thank Insurance Europe for the opportunity to deliver one of the keynote speeches at this event. The theme of this year's conference is the challenge of change, global insurance trends. And we have just heard from my good friend Sven Andresen from the FSB about the exciting work that both the FSB and the IAIS are undertaking together to support global financial stability. And during my time today, I would like to speak with you about some of the ways in which the IAIS assists its members in addressing the challenges presented by the trends affecting the insurance sector, and why we believe that change, however challenging, can be good. To do so, I would like to first highlight some global insurance trends that have and will continue to influence the IAIS's work over the next several years. But before doing so, however, I would like to begin, as I always begin my speeches, in mentioning our mission in the IAIS. And the mission is to contribute and to promote to effective and globally consistent supervision of the insurance industry in order to promote fair, safe, and stable insurance markets for the benefit and protection of policyholders, and to contribute to financial stability. Interestingly enough, this is with us for quite some time, but two elements have become much more important recently. The one is the word globally consistent, and the second is the contribution to global financial stability from an insurance perspective. I believe strongly in this mission, as do my fellow supervisors, and we seek to achieve its goal of effective and globally consistent supervision and global financial stability in all we do by addressing the needs of supervisors who operate in the global insurance marketplace. In doing so, we also must take care to address the needs of all our members, who are not just big developed countries, but to a large extent also emerging and developing markets. For, as some of the trends I will mention shortly demonstrate, the insurance industry is not and will no longer be solely dominated by one or two large traditional markets. Rather, it has become and will continue to grow more global, more consolidated, and more interconnected. Turning now to the trends we face, one you likely hear most often is that insurance market is becoming more global or more globalized. Another way to describe it would be the market is becoming more balanced. Either way, the numbers show some startling trends over the last several years. According to figures released by Swiss Re, in 2007, almost 75% of the global insurance market was held by two regions, North America and Europe. At the time, Asia comprised just a little more than 20%. Step forward 5 years to 2012, and the landscape is already dramatically different. Europe and North America are still the two largest markets, but they have lost together more than 11.5 percentage points of their combined market share to the rest of the world. The three largest regions, Europe, North America, now Asia, now have become more or less equal market shares of around 30%. The regions with the biggest gains over this period are no surprise, with Asia and Latin America leading the charge. These figures are supported by the OECD's most recent report on global insurance market trends. What has happened as a result of these trends is not surprising. As growth within established markets remains weak, large insurers have increasingly looked to emerging markets to fuel growth. This can, of course, occur through the establishment of new or the growth of existing operations or through acquisition. but in either case, often results in the increased globalization and consolidation of the industry, as well as increased risk transfer between the regions. The question then becomes what we as supervisors should make of these trends and how we should address them. The answer is quite simple and luckily fits squarely into the mission of the IAIS. As the insurance sector grows more global, our supervisory focus must continue to expand globally. We must keep up by tailoring our supervisory methods to deal with these large international and complex firms. We need to be aware that more and more markets are becoming relevant from a business perspective. That's what I called increased balance before, and consequently from a supervisory perspective as well. As this continues and business operations get more and more interlinked globally, a pure jurisdiction by jurisdiction approach with regard to standards and implementation is no longer sufficient. In other words, it is not enough to simply focus on the country level in dealing with highly complex international insurance groups and highly interconnected insurance markets. These trends and realities have not been lost at the IAIS. We have for some time increased our focus on continuing to improve group supervision. In fact, as the global insurance marketplace continues to grow more complex and interconnected, we feel it is critical that cooperation and coordination among supervisors continue to improve, such as through the use of supervisory colleges or the IAIS, a multilateral memorandum of understanding. And as the insurance sector becomes more interconnected with other sectors, we must also learn how to better communicate, cooperate, and coordinate with supervisors from other sectors. In this context, one of the IAIS's main initiatives over the last several years has been the development of a common framework for the supervision of internationally active insurance groups. COMFRAME is a set of internationally supervisory requirements focusing on the effective group supervision of internationally active insurance groups, or as we call them, IAIGs. COMFRAME is built and expanded upon the high-level requirements and guidance currently set by our insurance core principles, which generally apply to both legal entity and group level. The development phase of COMFRAME began in 2010 and concluded in 2013 following public consultation on the latest draft of COMFRAME. Based on the results of this consultation and subsequent meetings and dialogues with the industry participants, the IAIS is in the process of finalizing COMFRAME for the purpose of field testing. As for field testing, this began in earnest in March with the initiation of our first request for data from our field testing volunteers, some of whom I see here in the room today and would like to personally thank for your contribution to this important project. Field testing will end in 2018 when COMFRAME is scheduled for adoption. Further, as announced last year, IAIS has agreed to develop by end 2016 the first ever risk-based global insurance capital standard, or ICS, and to include it into COMFRAME. Response to this announcement has admittedly been mixed. There has thankfully been much praise and recognition of the need for a global approach to solvency, and in particular also to capital. There has also been some trepidation with assertions that our current patchwork of regional and local capital standards is not broken and therefore not in need of being fixed. Others have already labeled the ICS bank-centric or Europe-centric, despite the fact that its development is but a few months old and being far from anywhere from being final. Also, I wholeheartedly welcome debate on the substance of the ICS, and there is still much to debate over the next few years. I think it is time we move past the rhetoric and instead focused on achieving the best possible outcome. We simply cannot practice reactionary regulation and wait for a crisis before we, both supervisors and the industry, take action. Let's just wait and see is certainly not an appropriate strategy to achieve policyholder protection, sound insurance market, and a stable financial system. We need to act, and we need to act now. As I've said before, it is undeniable that the business of insurance is global, and global issues demand global responses. It is also undeniable that the mission of the IAIS is to promote effective and globally consistent supervision of the insurance industry. As caretakers of a promise to policyholders, we have no option but to recognize trends and act accordingly. It is for these reasons that our members, who constitute nearly all of the world's insurance supervisors, have committed to develop the insurance capital standard. However, the IAIS has also committed to develop two other capital standards. Already in 2014, the IAIS will develop the basic capital requirements, as you know, the BCR, which are planned to be finalized and ready for implementation by GSIs, globally systemically relevant insurers, in late 2014. BCR will serve as the foundation for the third capital standard, the higher loss absorbency requirements for the GSIs. And it is anticipated that their development and testing that is going on will also inform the later development of the ICS. Although the determination of capital required for BCR is under development, I can tell you that it is currently envisioned as 6 factors applied to 6 exposures, reflecting the main categories of activity, namely traditional life insurance, traditional non-life insurance, asset, the asset liability matching, the non-traditional business, and also the non-insurance business. The BCR mandate requires consideration of all these items, and the approach also addresses the BCR principle requiring that major risk categories should be reflected. And it should be an insurance capital standard. Insurance is typically a long-term liability-driven business, and this drives the need for managing assets to reflect their relationship to the liabilities. The inclusion of asset liability matching into a simple capital standard is a particularly considerable challenge, further supporting our approach that a final decision can only be made by taking into account data issues and field testing results. I should also note that we are well aware that a major challenge to achieving the principle of global comparability of the BCR is overcoming differences in valuation approaches. To address this issue, we contemplate that the primary valuation basis for the traditional life and non-life exposures will be current estimates of liabilities, and that the primary valuation basis for assets will reflect their fair values. The first public consultation on the BCR just recently concluded, and the IAIS plans to hold a second consultation over the summer, so I look forward to your input on this important initiative as it continues to develop. I mentioned the third capital standard being developed, which is higher loss absorbency capacity, or HLA, for GSIs. Let me remind you that HLA, higher loss absorbency capacity, is one of the 3 essential building blocks of policy measures for GSIs, the 2 other being enhanced supervision and effective recovery and resolution. The HLA requirements will be developed in 2015 and will apply from 2019. In addition to exposing a need for enhanced group supervision, the financial crisis also demonstrated the critical absence of effective mechanisms to monitor the growing complexity and opacity of financial institutions and assess the extent of cross-border exposures. Accordingly, last summer, the IAIS released its framework for implementing macro-prudential policy and surveillance, or MPS, in the insurance sector. In contrast to macro-prudential supervision, which is concerned with the viability of individual institutions or groups, MPS takes a market-wide perspective with a view to maintaining financial stability. Its focus is on enhancing the supervisory capacity to identify, assess, and mitigate macro-financial vulnerabilities that could lead to severe and widespread financial risk. As part of the macro-prudential framework, the IAIS is encouraging the development and enhancement of supervisory capacity to identify, assess, and mitigate macro-financial vulnerabilities in areas of economic significance to the insurance sector. And that is very different from what is done in relation to the banking sector. The macro-prudential framework will support the goal of maintaining financial stability and minimizing the incidence and impact of disruptions in the provisions of key financial services and products. Going forward, the IAIS plans to further refine the MPS framework by issuing guidance on the practical application of related IAIS insurance core principles and by developing a toolkit and data template of early warning risk measures to be leveraged for stress testing. In addition to those activities, the IAIS has also addressed recent global trends by increasing our focus on matters of corporate governance and risk management. The IAIS actually has a long history of focusing on the promotion of sound corporate governance and sees it as one of the three main pillars of insurance supervision, in addition to financial supervision and market conduct supervision. Just also referring to the question of the weight of the different pillars in supervisory system, as was mentioned this morning. Within the area of corporate governance, the IAIS is currently working on the following issues. Firstly, a review of ICP 4 on licensing, 5 on the suitability of persons, 7 on corporate governance, and 8 on risk management and control function, following the outcome of the self-assessment and peer review exercises we have undertaken in this area and the current revisions to ICP 23 on group-wide supervision, as well as other relevant ICPs with regard to group supervision aspects. Secondly, amendments to ICP 7 itself on corporate governance to include supervisory material related to external audit and the responsibility of the board in relation to external auditors. Thirdly, revisions to CAMFrame based on comments provided during consultation, and the development of teaching material for supervisors, presentations and case studies on the governance-related ICPs. Furthermore, the IAIS Governance and Compliance Subcommittee has also drafted an issues paper on approaches to group corporate governance and the impact on control function that provides insights into implications that arise for insurance groups of various models of governance. The issues paper identifies key characteristics of good governance applicable to all insurance groups. The variety of approaches to governance within insurance groups can have different challenges and different impact on the control function. And the paper aims to create awareness for insurers and supervisors of the different approaches reflected in governance structures of insurance group and the associated challenges. And over the course of developing CAMFrame, it became apparent that there was widespread concern that CAMFrame might apply a one-size-fits-all approach to group-wide corporate governance and might state a preference for a centralized approach. This paper should clarify that this is not the case. Also, CAMFrame expects an IAG's governing body to have some degree of oversight of the group as a whole and to have group-wide objectives, strategies, policies and reporting. It is not intended to require a specific governance model for an IAIG. CAMFrame explicitly states that it does not favor any particular structure. It only sets out the outcomes which should be achieved within the chosen structure. Finally, let me end by noting that since its inception, the IAIS has recognized the need to engage and involve supervisors in emerging markets. This is reflected in our membership, which spans the globe and includes nearly every insurance supervisory authority on the globe. We believe that by responding to the needs of emerging and developing countries, we can address market development and stability issues and risks. We also believe that engagement in financial inclusion issues, especially microinsurance, responds directly to the needs of many IAIS members to develop fair, safe, and stable insurance markets, which is, as you've heard, a critical part of our mission. And we believe that by overcoming barriers to access to insurance, the economic development and well-being of the population will be promoted. In conclusion, let me again state that as caretakers of a promise to policyholders, we have no choice but to recognize trends and act accordingly. In other words, we cannot practice reactionary regulation, and we need to act, and we need to act now. And this brings me back to the theme of this year's conference, the challenge of change, global insurance trends. We should not forget that change is inevitable and that we constantly face the challenges of change. But I'm fully confident that we, both supervisors and the insurance industry, will manage those challenges successfully. Thank you very much for your attention.